Hello guys, welcome to my YouTube channel again. So today we're gonna look into one of the most valuable and the most credible topic of advanced corporate finance, that's sensitivity analysis, which is a part of our risk and capital budgeting technique. So what is the sensitive analysis? So first we're going to look into the meaning of sensitive analysis today. So the meaning of sensitive analysis is that sensitive analysis is a tool used in financial modeling to analyze how the different values of set of independent variables affect the specific variables under specific conditions. So here we're going to see that how the set of independent variables affect specific dependent variables in a specific condition or in a controlled environment. Then we have applications. So where and all the sensitive analysis is used. So when it comes to applications, we have business analysis, investing, then we have environmental studies, we have engineering, physics and chemistry. So how this sensitive analysis works in business analysis? So let's take an example. So in case of business analysis, in a part of business, we're gonna make profits, we're gonna see into sales, we're gonna look into the revenue. So the sensitive analysis is gonna focus on your sales, revenue and your income in the future or in an upcoming project. So that's how business analysis works with sensitive analysis. Let's look into the investing. So when it comes to the part of investing, we have equity valuation, we have return on assets. This is a reasonable way to analyze the profits or returns concerning asset is the mean of evaluating company for investment purpose. At that time we use sensitive analysis. So then in environmental studies, like geographical departments use for weather forecasting, for change in the climate, for that they use. Engineering, physics, chemistry department also use sensitive analysis with their respective studies. Then what if analysis. So what if analysis also another name for financial sensitive analysis. So the financial sensitive analysis is to predict the outcome. So is to predict the outcome of specific action when performed under certain conditions. So financial sensitivity analysis is done with a defined boundaries. So it has certain limitations. That is with a set of predetermined inputs. That's with independent variables. So then we have steps involved in the use of sensitivity analysis. So in everything, when it comes to the matter of a theory or a model or an approach, we have steps or we have the process how to go on. In case of sensitivity analysis, we have identification of all those variables which have an influence on the projects of NPV or IRR, on net present value. So know the mathematical relationship between the variables. So here in the step 2, we will know what is the mathematical relationship between the variables. For an example, the sale of an unit, or with an example of revenue increased. So that's where the mathematical relationship comes into existence. Then we have analysis of impact of the change in each of the variables on the project's NPV. So what is the impact that an independent variable is doing with another certain variable that's reflecting on your NPV. So how it's affecting your NPV with regards to your independent variable and under certain circumstances or under a controlled situation. That's one. Then we're gonna look into the assumptions. So what are these assumptions? So when it comes to the sensitivity analysis, it shows on forecasting. Forecasting error can affect both feasibility and of the project and the value of the company or the building. So in any situation, the results or the value will vary greatly due to the forecasting error. So what is the solution for this? It is better for the valuer to give the answer in 3 different situations using the three different assumptions. If he gives a final answer directly, then the valuer may face a situation where the company can go disaster if the answer is not accurate. So what the valuer does is the valuer gives results in these 3 different ways, that's pessimistic, optimistic and most likely. So what is this pessimistic approach does? This pessimistic approach will give you the lowest possible value or the lowest possible NPV of an project. Then what is optimistic? It will give you the highest possible value of the project with the highest NPV that you're going to achieve. Then what is this most likely? Most likely can also be called as expected or an expected return of an NPV. This will give you the current situation. So let's take an example of an return. So pessimistic gives you 10% less returns, optimistic gives you 10% more returns, and most likely or the expected one gives you the current return that you're gonna get in the market. So after this, we're gonna look with an example that how an sensitive analysis work with sales. So John oversees sales for holiday company, a business that sells Christmas decorations at shopping mall. John knows that holiday season is approaching and the mall will have a huge human traffic or the customer traffic getting into the mall, and will the total revenue of sale of the holiday company will rise. If it's going to rise, by what percentage or by how much dollars or how much rupees? So the average packet of a Christmas decoration is $20. So when it comes to the previous year or the historical data of holiday company, they sold 500 packets of Christmas decoration in the previous year with sale of a $10,000. That's $10,000 is the sales revenue that the company generated in the previous year. So after carrying out a financial sensitivity analysis, John determines that a company that's XYZ company can increase its customer traffic at the mall will result in 7% increase in number of sales. So there will be a increase of 7% in sales compared to the previous year. So using this information, John can predict how much company X, Y, Z will generate if the customer traffic increases by 20%, 40%, 100%. So let's look into this with an Excel example. So Excel, so this is an example that I gone through, which is most easiest, and this will give you a clear cut idea of how the sensitive analysis work. So here in the column B we have mall traffic growth, C we have unit price, and D we have sales volume, and E we have revenue, and F we have revenue increased. So here in the B column, as you all can see, there are the percentage that are mentioned, and C we have the unit price, and D we have sales volume. So what we're gonna do here is we're gonna multiply the unit price into sales volume, and we're gonna get the revenue of each item, and we're gonna compare this with revenue increased. So when there is zero traffic in the mall, we have no revenue increased, and the total revenue would be 10,000. If the mall traffic growth is increased by 10%, and if the sales volume increases by 535 units or the volume, then the revenue will be 10,700, which is 700 rupees more than the previous one. So we'll have a 7% growth. In the same way, when we look into 40%, there is a sale of unit of 640, and there is 12,800. So there is a 2,800 increase. That's 28%. When we look into the 100%, that's with the 850 units of sale, this is the maximum sale that the company can achieve. So here we have 17,000. So there's a 7,000 difference of revenue. So there is a 7,000 increase in the revenue. So that's by 70% your revenue gonna increase. So let's look into the previous example there. So here they say that the traffic will result in increase in the revenue by 14%, 18%, and 70%. If there's an increase of 20%, 40%, 100% sale, and this will result an increase in the revenue by 14%, 28%, and 70% respectively, as we saw in the Excel calculation here. So that's 100% will give you the 70%, and 10% will give you 7%, and 20% will give you the 14%. So what are the advantages you're gonna get through sensitivity analysis? So when it comes to advertising, the sensitivity analysis can be used in three ways, or the three wide set of possibilities. That's through optimistic, pessimistic, and most likely approach. With these three assumptions, you're gonna get a credible result of the company where you're gonna have three situations where your company can stand. That's one advantage. Then here you have flexible boundaries here. For example, you're gonna test the sensitivity of dependent variable to the independent variable. So you're gonna make the decision based on this. So you are going to be an informed decision maker here. You have informed choices, the predetermined choices, and you will also be aware of how responsive the output is to change in certain variables. Thus, the analysis can help in deriving tangible conclusions here. Then here you're gonna identify the weak spot and you're gonna strengthen that weak spot using sensitivity analysis. If the company is going to lack with any of the example, then you're gonna look into the most possible result that you're gonna get to strengthen that weak spot. Then what are these limitations you have? So the limitations can be does not provide any clear-cut results for you. It is not going to get you any clear-cut results in case of because here you have three approaches: pessimistic with lower results, optimistic with higher results, and most likely with the correct result. So you are not getting accurate. You are having choices there. There is the possibility you may get, but it's not clear. Then the term optimistic and pessimistic may mean different views in a different scenarios in different organization or in a different person. So this range of values suggested may be inconsistent. There is no consistency. It fails to focus on the interrelationship between the variables. It just acts with the dependent and independent variable, but it's not focusing on the interrelationship between the variables. Then what are the best practices in sensitivity analysis? This means where and all you can, what are the best applications or what are the best media where you can use sensitivity analysis. You can use it in Excel for the best results, which you gives a direct results there as we saw in the previous calculation with an example. Then direct versus and direct versus indirect method. Then through using graphs, table, charts. We are open for question and answers. You can directly contact me at neerunj456@gmail.com. I'm open for your queries and questions. And thank you for watching this video, and please don't forget to subscribe my channel. And thank you guys. Thank you for watching this video.